even just for the just completed month of September, gold was up 5%, where the last 5 years in September, gold's been averaging down 3%. Well, it goes up 5. Silver goes up 8. And the GDX was up 3. And it's, oh gosh. And with everything that's going on geopolitically, it's pretty hard to make any, declarative statements about this is going to happen next. I mean, we're living in some unprecedented times. And so people need to stay pretty nimble and try to keep an eye on maybe the big picture, not so much the day-to-day swings, but, ultimately where some of this stuff is headed.
In today's news recap, silver price rises to near 31.50 due to rising geopolitical tensions. Silver price extends its gains for the second consecutive day, trading around 31.50 per troy ounce during the European hours on Wednesday. The upside of the silver prices is attributed to the safe haven flows amid escalating geopolitical tensions in the Middle East. Iran launched over 200 ballistic missiles at Israel on Tuesday, shortly after the U.S. had warned that a strike was imminent. The Israel Defense Forces reported that several of the missiles were intercepted, according to Bloomberg. On Tuesday, the weaker than expected numbers made room for the U.S. Federal Reserve to continue lowering rates. The index came at 47.2 for September, matching the reading with August's print, but came in below the market expectation of 47.5. However, Fed Chair Jerome Powell said on Monday the central bank is not in a hurry and will lower its benchmark rate gradually over time. The CME FedWatch tool indicates that markets are assigning a 62.7% probability to a 25 basis point rate cut by the Federal Reserve in November, while the likelihood of a 50 basis point cut is 37.3%, down from 57.4% a week ago. Prolonged higher interest rates keep the opportunity cost higher of holding non-yielding assets like silver, making it less appealing to investors who seek more attractive yield-bearing alternatives. Silver demand has been bolstered by China's fiscal and monetary stimulus, particularly benefiting industrial applications in one of the world's largest manufacturing hubs. However, weaker than expected demand growth in China, compounded by data indicating a decline in manufacturing activity, might have limited the upside potential of the gray metal. Now we'll show you the best clips of the latest interview, but first smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Price would have been weak. Dollar index was rallying, the future rate cut we started the year, they were talking about 7 rate cuts, and that went all the way down to 0 or 1 by June. And under those kind of conditions, you'd have thought that gold would go down. Instead, it's been charging forward all year long. We're currently up 30% year to date. I don't know, how much farther can it go in 1 year? I've said to lots of folks, they'll be like, well, if the banks manage the price of gold, how come it's gone from 400 to, 2,500 over the last 20 years? And that's because, the banks and their traders can profit from a 10% rally because it's up, down, up, that kind of thing. They can manage that just fine. It's 30%, 50, which we've never had a 50% year. That gets them upside down in a lot of their positions. And that's kind of what it seems like they are now. If you look at the Commitment of Traders report, doesn't mean that price can't go higher. It certainly can. But it's going to take more speculator interest, institutional interest on the long side in gold in all its forms, because there's not many shorts left to be squeezed. So it's going to have to be continued buying to keep pushing us farther. That's why things like, we just wrapped up the quarter yesterday. The month-end charts and certainly the quarterly charts are really important in revealing what is a serious bull market. And that's where, that money comes from to keep propelling gold higher, because, people, what is it? The current number is like 72% of all global financial advisors don't even have any gold at all for their clients. If that starts moving up, that's where the the continued buying comes from. So anyway, we've had a heck of a year. We enter now into October in the fourth quarter, which, I mean, Jesse, all bets are off, man. There's no way of knowing what lies ahead, not just for the precious metals, just for life in general. So it's been a hell of a year, and we'll see where we go from here. All I know is I'm sure glad I own the gold that I do. And anybody watching us wondering about gold, wonder if they have enough. If you have to wonder if you have enough or if you should get any, you probably should get some, because we're in some tumultuous times, that's for sure. It's aggravating for many people, right? Because even though silver closed really well to end the month and the quarter, and you're like, hey, look at that, $31, $32. That's the highest it's been since for a monthly close since January of 2013. So if you've been buying all along like I have and have lowered your cost basis down into the teens, okay, that's fine. But if you bought, the last silver you bought was in January 2013, you're just now even, right? And so it's just aggravating as all heck. My suspicion is if gold keeps going up, silver will rush again to catch up. That's might have been about the last time we spoke, Jesse. I don't recall. I remember telling folks back in March and in April, as gold was charging, but silver was still around $24, $25. I'm like, well, the gold silver ratio is not going to 100. I mean, eventually silver is going to rush to catch up. And that's exactly, it went from 24 to 33 in about 6 weeks. If gold keeps moving forward here, the same thing will happen again. And you'll get another burst forward. But it is aggravating to watch. There's no question about it. It's thought more as a commodity than it is a monetary metal still by most of the world. And so it kind of has more in common with something like copper than it has gold for the traditional investment strategy, whatever that is. And so we kind of need all commodities to go, kind of forward to drag silver along with it. And we may be on the verge of that. The dollar index is at a very important technical level. If it should start to trade down below 100, that's going to drive a bid for commodities in general. I remember seeing a thing in August that if you look at a basket of commodities, some 20 commodities, as measured, I think it was Reuters or Bloomberg, the hedge funds collectively as a group were more net short that basket of commodities than they'd been in 20 years. And so you think, well, that's got to be a contrarian sign. And so if we get the dollar to fall, we get gold to keep going, silver will rush to catch up again. And we have the chance of finishing the year pretty strong. But again, those are some ifs. And there are I know investing is always about ifs and planning and trying to have as much foresight as you can. But as we enter this final 5-week period before the U.S. election, and with everything that's going on geopolitically, it's pretty hard to make any, declarative statements about this is going to happen next. I mean, we're living in some unprecedented times. And so people need to stay pretty nimble and try to keep an eye on maybe the big picture, not so much the day-to-day swings, but, ultimately where some of this stuff is headed.
In today's news recap, Goldman Sachs sees gold's price at $3,000 by year's end. Analysts at Goldman Sachs see the current dip in gold's price as temporary and expect the price to be at or above $3,000 per ounce by year's end. Goldman Sachs sees continued tailwinds for gold amid an ongoing flight to safety due to geopolitical risks, continued buying of the commodity by central banks, and rising demand among Asian households. Gold demand in China is particularly strong, notes Goldman Sachs, with the People's Bank of China, PBOC, increasing its gold reserves for 17 consecutive months. In March alone, the PBOC added 160,000 ounces of gold to its reserves of the precious metal. The gold accumulation reflects a broader trend among central banks to diversify their reserves and lessen their reliance on the U.S. dollar, the world's reserve currency. Gold's price has risen in recent days after the U.S. Federal Reserve hinted that interest rate cuts could be on the horizon and ruled out any further rate increases. Lower interest rates increase gold's appeal as they reduce yields on fixed income assets such as bonds. Now, we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
It's maddening, isn't it? Even just for the just completed month of September, gold was up 5%, where the last 5 years in September, gold's been averaging down 3%. When it goes up 5, silver goes up 8, and the GDX was up 3. And it's, oh gosh. My site has always been about stacking and accumulating physical metal for your safe harbor, inflation protection, purchasing power protection, get you through this storm, this transition period that we're now clearly in of monetary systems. The mining, I swore off the mining shares a couple of different times over the last 15 years because they just destroy capital in a lot, because they don't hedge themselves worth a damn in terms of inflation. And so their costs are constantly going up and eating into their margins. And so when the price of gold and silver going down and inflation is going up, the things just, they don't do well. Now, the problem has been, and the frustrating part has been, is the price of gold and silver has been going up this year. And yeah, the shares are up, but they're not dramatically up. And in the end, that gets to a simple supply versus demand. You got to have more buyers and sellers. And the sector as a whole is so not even unloved. Remember when we were younger, I remember hearing the adage about, the opposite of love is not hate. You don't fall in love with somebody, and then when it doesn't work out, you don't hate them. You just kind of become ambivalent, right? And that's kind of what the sector is just ambivalence. People don't even, it's not even on people's radar. The average financial planner, stockbroker, even all the way up to hedge fund, home office, the people that run a couple $1 billion, man, they're all worried about growth. You run a hedge fund and you're getting 2 and 20 every year, right? You're getting your 2% management fee and 20% of your profits. You need growth. You're not worried about what Newmont is making and they're all in sustaining costs, man. You want to be in NVIDIA and all these other growth stocks so that your 2 and 20 keeps growing. You could give a damn. And you're sure as hell not going to own any physical gold because it doesn't pay interest. You can't wrap it in a fee, right? And so it's just not even on people's radars. And so I think the mining shares, particularly for me, the sweet spot is kind of not the big ones like a Newmont or a Barrick. Someone like Agnico Eagle or Alamos or some of these, or Wesdome, the ones that produce but keep their costs really low, and the price of gold is double what their costs are to get it out of the ground. For crying out loud. Okay, I'm happy buying those. But again, as a sector, I think that's the problem. They're just outside of you and I talking about it. You don't hear, stockbrokers talk about it with their clients. You certainly don't hear it on Bloomberg TV, CNBC. And so till we get to the point where, it's on, that kind of top of mind, we continue to kind of languish. Now, the hard part, Jesse, is my experience has been with these things. When they go, right? You go back to, remember it well, January of 2016, the Hui index bottomed out at 99.16 on like January the 16th or January the 19th or something like that back in, I remember it well. The date was one of those dates. And over the next 8 months, it went to 280. Okay, so the thing tripled in 8 months. And that's the problem. It goes up so fast. If you're not on board at the beginning, you end up chasing or you end up buying in at the end, and then down they go again. So that's again what is so difficult. That's why it'll just rip your heart out sometimes. Anyway, that's a long answer. I've had a lot of coffee. I don't know if I answered your question.
What do you think of today's show? Do you agree with Hemke? Are you bullish gold and silver in the fourth quarter of 2024? Post in the comments section down below your honest opinion and share with the stackers your views on the metals. Thanks for watching. Now peep this video right here because it's a perfect fit for you. I'll see you on the other side.